Hey everybody, hey traders, happy Thursday. Welcome back to the final hour. It's 3 o'clock, January 9th. Markets closed today in morning of Jimmy Carter, tradition that goes back to Lincoln's assassination. So not a surprise. It was actually kind of nice just to have a calm day. Curious what the markets bring tomorrow. We have non-farm payroll in the morning. Let's take a look at the expectations. So let's go to Friday. And then next week we have inflation data coming out of the U.S., PPI, CPI on tap on Tuesday, Wednesday. Just saw this afternoon we have TLT just posted $7.4 billion in net outflows over the last 2 months. This is nearly double the previous record seen in mid-2020 at the beginning of the bear market in long-term bonds. Crazy stuff. I want to say that I may be a bit of a contrarian on that. If you see like that type of record outflow, we'll take a look at the instrument. But to see that type of record outflow, it almost looks like nobody's trading it. Sometimes that offers up some of the biggest opportunities. So may make traders uncomfortable to just catch a falling knife, as they say. That's the fundamentalist nightmare. But or I guess technical traders' nightmares. I don't catch falling knives. Anyway, there's just a funny dinner time joke over that. And then also we have ISM data that came out and showing that prices paid by purchasing managers are at a 22-month high. And that puts it in perspective where ISM prices paid were as high as they were back in February 2023, meaning inflation continues to be sticky and or hot. This might even be called a second wave that is getting underway. Obviously, we're all wondering, like, will it be curbed or will it be stopped? Is it going to be worse than before, like we had the peak at 9+%? That was obviously terrible, but nobody knows. Is this just going to keep going and something has to break in order to get fixed? And that's my concern, is that it's been a pretty smooth couple of years. Honestly, I mean, since the recovery in October 2022, it's been a smooth couple of years. We've had booms and busts since 2018, so something tells me that we're due for some wild times ahead. But I could be wrong. Maybe the market's boring this year, but I just expect there to be a lot of volatility and maybe a lack of direction, but we need to trade it. So talking about Friday's non-farm, that's tomorrow when the markets resume. We'll see what the futures market does. So today, futures closed, but there was some activity overnight. Everything coming into the U.S. Open was quiet. Yesterday was extremely noisy, just poking the highs and lows. The black lines you see here, that's representing the 9:30 candle yesterday morning, and there was no breakout candle today because markets were closed. So we're still down for the week with the gap higher on Monday and fading. So Monday faded hard, Tuesday up and then faded again. Wednesday very choppy. Friday with non-farm payroll, we're still stuck between a couple of levels. I don't know if non-farm is going to be a big enough catalyst to push this market into fresh breakdown territory. The daily time frame on the S&P, this would be my 50-period moving average, or that's actually a 100 moving average. So this is a 100 moving average. So a 100 moving average, a 144, and a 200. If we get pullbacks into the deeper levels, I'm just going to look for buying opportunities. So in here, looking for buying opportunities. I know that's a pretty wide area, but I'll start things off just in case we have a bounce off the 144, the 200. I'd love to see if I'm going to resume kind of more of a bullish trade that would get me back up towards, maybe all-time highs. I'd like to position that a little bit deeper, like the 144, 200, or if you connect the lows from the last maybe 12 to 24 months, maybe something like this. As long as this structure, this is just my outlook here, as long as this structure doesn't break. So if the bears can't break, let's say 540 right now, $540. If the bears can't break 540, I'm not super bearish. So if we have any corrections, understandable. I'd love to see a pullback, but I'm still looking to be bullish in correction areas. Okay. If we break below 540, then there's two things. Either this is a break below 540 for a reversal pattern to occur, okay, and that's our like bear trap fake out, or this is we're breaking lower, this is a dead cat bounce, and we're continuing to flush lower, and like everything is switching from bullish for the last 2 years to then bearish and getting into a correction phase. But time will tell. Right now, price is sideways. So all we have to worry about right now is in the near term, is price going to break below the PCE low, below the holiday low, or is going to break back above and reclaim this FOMC before the FOMC kind of smashed the market lower on the 18th of December. All right. So Kyle, what's up, man? How are you? So we'll go good afternoon, everybody. Okay. So I wanted to see if I could find some trades today. Let's see. What would be a place to start this year? I've got a couple of trades in play on the option side. I'm really looking for financially healthy companies. And what I'm trying to find on this, I have a subscription here to Simply Wall Street. I'm looking for something along the lines with what is undervalued. I want to try to put in like a scanner, see if I can find help center. I'll try something here. I'm going to see if I can find scan for undervalued stocks. Price and value, get to know the stock, how to invest like the best. These are not really helping me. Removing stocks, modifying, updating portfolio. Probably need the help center on the screener. Okay, so stock using keywords. Let's try this. I guess I'll do this on my own. I'll figure it out. So I wanted to see, so for example, look at like Adobe. So Adobe fundamentally checks a lot of boxes, financially healthy, value play. Performance-wise, it certainly could be better for past performance. Let's take a look at fundamentals, price to sales, price to earnings, cash flow. I mean, price to earnings, let's look at it versus the peers. The one thing I like here is no major risks. The stock itself has been beat up pretty badly. ADBE, yep. So the stock is down to 420 right now. And, you know, I'm way more interested down here in 2022 where we had that bear market end, nice little head and shoulders pattern for that bottom. But anything like in the 280 area, I mean, I like this stock a lot. I was looking at this earlier this week for a trade. There's something I can get like a ratio spread or like a 1-1-1 trade. I can get that down into like the 350 area, but not much lower than that. So let me have a look here at Adobe. We're trading at a 12 IV rank, which is really, really low considering the stock has been, you know, selling off a little bit the last month or so. Let me take a look again at the analysis. So we're trading well below estimated value. Earnings are forecast to grow around 13% a year. Earnings have grown consistently the last 5 years. Good company value, blah, blah, blah. So it's good. I like that, at least for starters. Take a look at its peers. Current price versus fair value. I like that too. And this is what I essentially want to scan for. You know, if I could find a filter, and I'll do this on, I'll figure out the how-tos and the screener stuff. But if I can scan for, give me a list of stocks that are considered, you know, 30 to 50% undervalued or 30+% undervalued. This being one of them, it's like I don't care about price. I want to see what stocks are liquid and what's the average number of shares, so I can trade something that I can get a bid ask that's pretty tight. But this is what I want to scan for, right? So 33 times price to earnings compared to its peers, 32 times price to earnings compared to Salesforce at 52, pure average 72.2. So other stuff that would be competing in the space of Adobe is more expensive as far as price to earnings and what you're having to pay, right? So that being said, see price to earnings ratio versus industry. Yeah, I mean, I kind of like it. I do wonder. So fair PE at 49.9, like that's pretty awesome. Meaning there's room to grow into this. There's revenue growth ahead. There's probably price appreciation into this. So if I look at the stock itself, are we going to see, holy shnikes, that's a lot of class, or a lot of questions. Carla, let me read your comment there. Class you did this morning for daily profits was helpful information, encouraged that you continue to evaluate. Yep, I will do that all the time. Look, if I'm trading the strategy, which for every service I run, I am, it is my money. on the line with everyone else's too. So there's not a strategy I would be trading or teaching personally that I wouldn't be doing. So yeah, I hope that little session this morning helped, especially for new traders that are jumping into the course the last week or so. I've got another webinar today at 4 p.m. So I'll see if anybody is coming in and maybe want to join me for the first time. But yesterday's actually last week's masterclass, today's live session, since we didn't have the market open. So far this week, we are 3 for 3 in daily profit play. And going into the rest of the week, I'm hoping that we get some of those additional decays for my further out expirations, the ones that are in February, because they should be looking pretty good to hitting my profit target over the next maybe few days, hopefully. Let's see here. Kyle says, this morning you said you want to be in the trades that take advantage of the massive sell-off. If something breaks, how big a pullback would that be? If we're talking about TLT, I mean, I'm already in a position on TLT that I can talk about. What do you think of the almost 10K Bitcoin fall down to the last couple of weeks? It doesn't matter. I think Bitcoin is volatile and everyone knows it's volatile. I think Bitcoin should pull back to like 90, 80, $75,000 if we're going to have some efficiency in that chart. Bitcoin should be volatile. You know, Bitcoin pulling back only 15%. I mean, that's good. It's pretty tame, honestly. So I just think that there continues to be some pretty steady inflows into Bitcoin. It's now becoming a normal conversation to have with pretty much any money manager, any financial advisor. You know, it broke records on the ETFs. I mean, when IBIT came in and was allowing just your run of the mill stock and options portfolio, I guess just stock portfolio to invest into IBIT, it took what took GLD for gold, what took 8 years of GLD inflows, IBIT did it in less than a year. So, I mean, dropping 10K, it's like, fine. I kind of want it to, you know, I mean, I want pullbacks on Bitcoin. It's at 91,000. I said once this hits symmetry, I'm expecting a little bit of a pullback, and looks like we're kind of getting one here, right? So if we breach these lows, I mean, this to me looks like a high, low, lower, high, lower, low. I think once that correction plays out, I'm pretty interested in looking for more opportunities to scale in. Now, I can't say that this is going to be the guaranteed bottom. I think we still have a potential trend on Bitcoin out here. But I mean, I'm probably going to add some more exposure to it. But my timeline is not near term. Like if I'm getting into Bitcoin, I'm either buying more shares or I am using options and going out like, 3 months, 6 months, 9 months, 12 months. I'm just positioning for, hopefully I am getting some decent discounts and Bitcoin is going to be able to find a way to make higher highs later this year, maybe even make all-time highs again later this year. And I think a correction is totally fine. Okay. All right. Snowy Oklahoma. Well, that's cool. Yeah. Hey from snowy but sunny Utah. And hopefully, if we have anybody watching from California, hopefully everyone's safe. My gosh, man. Like, I don't think there is any tourism I could be shown to want to visit nor live in California right now. I mean, it's what's happening with those wildfires. It just seems to be getting worse and worse, you know. This time it was like fire started and Santa Ana winds at 60 to 80 miles an hour made it impossible to like keep up with it. So it just got worse and man, just what are you going to do? It's pretty wild stuff. So, all right, that is your question on Bitcoin. That's what I'm saying. I don't mind seeing a pullback. High, low, lower, high, lower, low, 90K, 80K, 75K. I'm looking for levels to scale in more. Okay. All right. I want to go back to Adobe for a second. I'll probably do this trade more tomorrow since we'll have a live feed, ADBE, down to 419. I'm surprised the Ivy rank is only 12, but I would like to take a look at this trade if I was willing to, and I don't really want to, but if I'm willing to own some shares of Adobe, I wouldn't mind owning some shares in the like 350 to, I mean, that's a big difference, but 350 to 285. Let me see what a 30-day, I'm always interested like a 30-day covered call. So if I do end up taking shares, that's not a lot of premium for a expensive stock. So if I did take any assignment at $350, 30 days out, I could lower my cost basis by about $10 to $15 to repair my trade. Okay. It's doable. I mean, I could go from 350 down to 335, 335 down to 320, 320 nearly to 300. I mean, it'd probably take me 4 to 6 months, maybe 3 months, 3 to 4 months to work my cost basis down to an attractive level where I'd say I'm pretty comfortable owning stock for the upside, right? If we came back down into these 2022 lows, then I wouldn't mind having some ownership. So ideally would be 300. If I just called out a number like 300, I like, but that's $120 lower. So get out of here. If I did anything in the 300s, I'm just not going out far enough. I'd probably have to go to like March or April. Let me see what April looks like. So I could get a little, I can't. I just went from, it looks like the 330 levels where I'd have to start my position because can you see, I don't know if you can see my numbers very well, but can you see the 330? If I bought this put and sold this put, okay, and I did a +1 at 330 and a -2 at 320, so I create a ratio spread, a put ratio spread. I want to make sure I'm getting enough income that if I don't get assigned, I mean, that would be like a 90+ chance of profit and about a 5% chance of assignment. If I did get assigned, I want to make sure it's, worth it to lower my cost basis to the point that I want to, which would pull my price back to like 305, maybe 310. Let's go 320 here, or 330 by 320, and put in. So income wise, I've got a 95% chance of profit. I'd only tie up about $3,200 on the trade for my, this is likely going to be for my portfolio margin accounts. So if I did this for portfolio margin, ties up about $800. If I did this for, let me put this in a cash account. So yeah, 31K in an IRA. I'm not going to do that. I would probably stick to my portfolio margin accounts. But it's a little income trade. April seems like I'm going out a little bit farther than I want to. Let me do the math here. If I took the assignment, so number one, I don't plan on getting assigned. There's a 95% chance of profit here. This is about a 5 delta, 6 delta sell side. So if I did take assignment, it would be 320 assignment minus $10 on the bear put spread, minus the credit on the trade. That's $1.73. So I'd own the shares at 308. This would take me probably 2 months to work my cost basis down to the lows that we saw back in 2022. Right now, if I own the shares, I would probably issue a collar trade and try to go after like a $5 or $10 profit. Now, I maybe I could get more if I just stay out of the way and I try to call more of the bottom there, but just not play any shenanigans with the market in 2025. If we're gonna have some nasty bear market that nobody sees coming or nobody knows how bad it's gonna get, I think I'm gonna put collar trades in essentially everything I own. So in the event of the 5% chance that I took any assignment of Adobe, it would tie up probably 15 grand or so in my margin accounts, which is okay. And then if I could repair that, so let's say that I could turn this into $1,000 profit. So $1,000 profit, and it cost me 15 grand to tie up my capital. I'd make a 6.6% return on that investment. Now, if I could do that in 30 days, that's not too bad. It adds up just like everything else. So it's okay, And as far as moving the needle, like $1,000 on PM accounts would be 1, 2, 3, 4, 5. So it'd be $5 grand that I could repair essentially. So it's not nothing. Like it moves the needle just a little bit. But yeah, I mean that's one way to do it. And if I did that trade, 10 times over from Adobe to Microsoft to MicroStrategy to Coinbase or whatever, all of them, it's just ways to try to generate income. There's a high probability of profit here. I've got the capital that if I needed to tie it up, I could, but I'm confident I could repair the stock, especially owning at 308. I mean, if I showed you this line at 308 and I said, okay, from the stock price right now, if I could own it at 308, would you look at that from a technical standpoint and say that's a pretty good spot to own the shares? I think so. When you look at a bear market in 2022 right there, and I'm pretty much right at that, I think within, let's say $10 to $30 of lows, I'd be pretty confident that I could turn that into a winning trade. There's also a big fat pocket there. There's nice inefficiencies that hopefully the market would, hold these lows. Let's see what that drawdown is, by the way. If Adobe from high to low, I mean, that's a 61% drawdown. So if we revisited that, or I own it at the 308 level, I'd own it at like a 56% discount. I would be okay with that. So anyway, I kind of like this one. I'm going to put this on my to-do for tomorrow. ADBE. Sounds like I'm saying the alphabet wrong. Let's go back to dashboard, portfolios, watch list. Okay, narrative, TAP. All right, let me see if I can just do. There we go. Like, give me, this is what I want to see. So weekly picks, it's like undervalued. Okay, fine. But like, I want to see the scan, right? Oracle. Okay, that's another one I would consider. It's cheaper than Adobe. Let's check out this one. So this is Oracle. Okay, not bad. So this is weekly picks. All companies, no. View narrative. Like Stickman Cyborg. Would anybody buy that? Nate F. That's just a contributor. Like, is this a name? Oh, Sinclair Corp. All right, whatever. These are just ideas from the community. Valuation for Adobe. Okay, let me go to Oracle. So ORCL. I mean, Snowflake-wise, this does a lot of good stuff. High-level debt's probably not great, especially at higher interest rates. But trading well below estimated value, earnings forecast to grow. Analysts in good agreement, stocks will rise by 20%. You know, when? Nobody knows. Sentiment and the market environment matters. Risk on, risk off matters. So you can pick a very strong stock and still get it beat up like crazy. 163 current price, fair value 276. I like that. ORCL. So recently had highs of $200, gave back some. This one's actually in a pretty strong trend. So this one is getting attractive enough that maybe a gap fill here, like the 150 and 140 zone. I might put this on the watch list as well for a trade tomorrow. So we have a 27, ouch, ORCL. We have a 27 IV rank. If I went out to similar timelines like April, and I've got $5 wide spreads, it's out 98 days. If I did a ratio spread, 153 is okay, but I like, if I'm going to take any assignment, again, below the 200 moving average, it could be an income trade, number one. It could be a backup plan, assignment trade, repair trade, number two, or an assignment trade and not a repair trade, but it's like, I'm going to own it. I'm going to own it and try to make as much money as I can on it. So there's kind of three layers to like getting into this trade. First off is I don't want to own the shares. I just want to trade options, generate the income, see the probability profit. So if I had something where it'd be like a 145 by 140, I really like that level. I want to see if I can get like a 145 by 140. I really like that level. So let me do this. I could do 114. I could do, how is that giving me less credit to add in another put? Oh, that's a debit. Okay, so if I add that in there, that's a put, 90 cents. I don't like that at all. If I did the 140 times 2, so $1.72. If I took on any assignment, I'd own it. 140 minus 5 minus $1.72. I'd own the shares at 133.28. Okay, 133.28 would be down here well below the 200 moving average. And we would go from high to low. Own this thing at 130, what did I say, 132? 133. Okay, my bad. 133. So own the stock around 133. That's a 32 to 33% discount. With a fair value and cash flow model that looks promising enough to get this thing back into the 200s. Now, again, do I want to own it? No, I think I'm going to hold it to $200+. Probably not. But if I can trade it for income, number one, there's an 88% chance of profit, which is less than Adobe. But setup is pretty good. The assignment risk would be a little bit higher. I could obviously I could push these lower. I could probably push these down a little bit. Let me see if I can at least get $1 of income. So I'd have to push this down to like a 140 by 135. That puts my probability of profit at 92%. Still get $1.20 of income. That lowers my cost base even further. If I did take on assignment 135 minus 5 minus 1.20, I'd own it at 128.80, which is even cheaper. Maybe a 10% chance of assignment. Technically, it's a 12 delta, so that'd be a 12% chance of assignment, but usually the expected volatility or the expected move is overstated, and this would be on the kind of the lower end of that expected move for the next 98 days. Now, there's going to be an earnings print in there somewhere. I wouldn't have a lot of protection during an earnings play, but I could obviously put on just a put play if I like it. But let's see, when is earnings? I don't see earnings. Let me see if it's on my chart here. I've got earnings March. So middle of March, we have earnings for Oracle. So if I owned it around the 128 handle, I mean, that's quite a bit lower than right now. So even a bounce off the 200 moving average or a push lower into 128, I think I could repair this. Again, let me look at the 30-day option to see how much could I repair it. I get like $3 to $5 on an at-the-money covered call. So if I did take ownership at 128, I'd only be able to lower the price by like $3 to $5 a month. And that's a repair trade. Okay. It's still an income trade. It doesn't tie up a ton of capital. If I am, again, I'm looking at portfolio margin accounts, it tie up like $500. That's crazy low. So very workable as far as option buying power. So, all right, I'll keep those on the list for tomorrow. Let's do a couple more. Also, let me sign in here. I've got a little scanner and see if I can just get some plays on some. If I've got some option traders out there, let's just look at some trades that are set up for some good premiums. So if you own shares in anything and you can sell covered calls against it, I look at like the yield and the premiums on covered calls, and then also what's high enough IV to consider like a cash secured put. So let me have a look here. Covered calls right now. MicroStrategy is like by far the best one. That the premiums on MicroStrategy are insane. HUT, I'm not sure what that is. Hutton Corp at $23. Tech data processing. Let's take a look at the HUT. This is Harvest equal weight. HUT 8. HUT 8. Okay, so this would be a stock that I wouldn't touch. Here's why. Price to earnings is below U.S. market. Okay, cool. Revenue forecast to grow. Okay, cool. Became profitable this year. Okay, but not past. So this is now like, is this company turning the corner? Analysts in good agreement. Stock price will rally by 47.5%. That seems like a lot, but non-cash earnings forecast to decline from 18, average of 18.3% for the next 3 years. Like that's a huge red flag. Shareholders been diluted and volatile share price over the past 3 months compared to the U.S. market. So let me see the IV, and MAR is another one. I think it's Rocket Lab, HIMS. Interesting. I'll take a look at those. SMCI, AMD and SMCI are somewhat appealing, but probably going to stay out of that. Let me go HUT and just take another look at it. Why is a put good? So covered call. Okay, so this is more of a covered call scanner. Got it. So would this be good if you bought the shares? So if I bought the shares at $23.50, let me see something here. It's obviously not super expensive, so HUT. If I bought the shares, let's say we take this out just before earnings. Okay, so the shares are trading around $23.50. If I bought the shares at $23.50 and I sold an at-the-money covered call, that lowered my cost basis by $2.41. Am I happy with that? No, I'd probably end up doing, if I did do a trade like this, I'd buy the shares at $23.50 or so, and I'd probably go to, let's say, what's the expected move? $6. So on the upside, I'd probably go up to around 29. Okay. And, can I get any premium for that? 30 days out, look like I'm not getting anything if I sell that. And if I buy it, buy a put to protect it, I'm probably gonna have to go out $4, $5, $6 to protect. So I could give myself, $6 of upside potential. Cover calls at the money are okay. They're okay. It's about 10%, right? If I paid $23.50, I'm getting a slightly better premium than that. So I could probably generate a few $100s on that. Do I love it though? Not really. IBM, you want to take a look at? How about this? You throw some stocks at me, I'll post it in here. IBM. Okay. Dividend not well covered, high level of debt, large one-off items, trading below estimated value, earnings forecast to grow. IBM to me is legacy tech. They have been talking about the what I do here. I took some profit on IBM. This was when this thing topped out. Yeah, this trade actually worked out really nicely. This was back in October, and I did when this first high hit, I did a bear put spread, close out for the 250 max. So it was $135 profit versus a 115 risk. So that trade's done. We're back up, near the highs again. IBM, I'd like to see some sideways movement. Something like this, where the tops are going to be difficult to revisit, and the lows might come back in and establish a range and maybe find the 200 moving average. So to me, I'd look to see, this has been in a pretty healthy bull market, pretty healthy bull trend. Is this good enough to go high, low, equal high, equal low, and just range? If we find range lows there, $200 or so, looking for a bounce. So not bad. Not bad. Do I love it? Let me see the IV rank really quickly. IBM. IV's at 90. What? 93.9. Good Lord. We have earnings. That might be an earnings play. I'm going to write that. That's a good watch list item there. Holy shnikes. That is high IV. I don't know why, because the price hasn't been that crazy. That's a very high IV. So what's an at the money covered call? Yeah, baby. Look at these covered calls. That's like 20% on a covered call. Let's see what IBM shows. So IBM, trade-wise, looks like a bull call spread looks pretty promising. Going out to March. Income-wise, covered calls aren't terrible if you own the shares. Is that a put? What is this trade? Just says covered call. I mean, I kind of like IBM. That is really high IV, where you could do a lot with that. I think this is potentially like ratio spread. Let me see. Correction wise, if we go from high to low, it's about a 14.5% correction. Assignment wise, earnings is the end of the month. Okay. So we have some earnings. I think what I might end up looking at on IBM would be, this could be risky. But if I did an earnings play, let's say so January 29th is the earnings. If I went out to the February 7th, I go out like 1 or 2 weeks past earnings and I just do a credit spread. If I did a, 220 by 215. So I get it's 5 wide. I would probably do something like this. So we're trading around 223. If I did this is not bad, a 225 by 220. And what I would do with this trade would be, if the stock drops on earnings, I would probably take the put and close out the put for profit, and then await the assignment and add in a collar trade to repair it. Okay. So I think this is going to be a trade I look at tomorrow. If I wanted to just, the income trade is this. If I did just the 220 by 215 bull put spread and it goes higher, well, that's easy. I'll make basically $3 for a $2 risk. That's a good trade. I do have some protection to the downside. I would get assigned, at the 225, which I don't love. So what I want to look at is, could I go a little bit lower and say, all right, if this is let's say this is just a range, comes back to this low and then bounces back up. I've got to be willing to say maybe this 200 moving average could offer a bounce, right? I mean, it either does or it doesn't. So if I was willing to take the assignment here, I've got to have some protection just in case this is not going to be great. I mean, one thing that's kind of wild about IBM is how did this thing since May of 2023 start to look so darn attractive? I mean, what was it about IBM that nobody gave a funyun about for the last 7 years? I mean, look at this thing. Who cares about IBM for the last 6 or 7 years? This stock has done jack squat, and a dividend at 3%, big whoop. I mean, your price has gone from basically the same low, the same high for 6 years, but all of a sudden it just catches fire. And I don't know if this is because like tech leads the way. They start to say the right things on AI. They say the right things on semiconductors. And all of a sudden this stock makes a run of 98% to the upside. So again, what's realistic? We do have some structure here. So if we have a pullback, I could see that offering some support, and maybe this is able to go to all-time highs. Or based on a bigger correction in the market, is this just right back into a nasty correction halfway point? Here's a low, here's a high. Does it come back to equilibrium? Maybe. Does it come all the way back down to these freaking lows at 120? Maybe. That's why I'm saying if I have any ownership, I've got to be able to say I'm going to ride this thing as low as possible if I'm wrong. Yeah, they've got earnings coming up at the end of the month, the 29th. So what I'm saying is I would look at, I mean, heck, there might be enough to say I could look at earnings in like the 170s and do a ratio spread because that's way out here. If I did like, I can't do it to 29 days out. I got to go further out. So let me go to April. Okay. I like this. If I'm going, out for like a decent income trade, like 60 to 90 days. So here's basically 98 days in April versus 71. It could be either or, but April or March, 175 by 170. It's not bad in there, but premium wise, it's pretty crappy. 180 by 1. This one's not bad. A 185 by 180 is not bad. Unfortunately, though, I'm not getting the I was hoping I could get like $1.50 or $2 on that income trade. It's a 93% chance of profit. I'm making 94 cents. I would be willing to take on the shares there with an ownership of like basically it's going to be 174 and change. But I don't like it enough because I thought that premium would be better. A 190 by 185. Now I get over $1, but decreasing the probability of profit. I'd own the shares now at like 179 and change. And if I'm going to be picky, it's like, okay, 170 to 165, I could justify saying I own IBM in the area. So realistically, I think the better trade for me is, and this is a riskier trade, but if I did a bull put spread on IBM where I sell like a 225, so I'd sell a 225 put, I'd buy a 220 put, and if price goes up on earnings, I win. If price goes down on earnings, I've got to be willing to ride that lower, take the assignment, okay? Take the assignment or just take the loss, right? If I lose $200 and I don't tie up any capital. I guess that's one way to look at it too, but there's got to be like better areas to figure out like where can this thing go during earnings. Anyway, food for thought. So I'm putting that one on the list. So Oracle, Adobe, IBM, I'll take a deeper look at those tomorrow and see what I can find. But this, I don't like the risks. Okay, like high level of debt. Okay, how are they servicing that debt? Can they afford to service the debt? Dividend not well covered. Does that change at all? But earnings are forecasted to grow. It is profitable. Price to earnings, price to sales. Let's see what that looks like. Let's see what it looks like versus peers for price to earnings. So 223 fair value is 281. 20% undervalued versus 40% undervalued is a big difference. And then peer average is 27. IBM is 32. So it's I guess I could expect. I mean, the IV is nice, but I don't know. It's almost cheaper. It's almost cheaper just to trade a collar. Like the premiums are so good in the short term. If I go out through earnings, let's say I go out past earnings into like the 7th of February. If I just buy the shares right now at 223 and I sell, let's see, 223 and I sell against it. Okay, and then I buy against it. So I go up $7 on the upside, and that would be $13 on the downside. Maybe I go this way. So this isn't a bad consideration. If I buy the shares at 223.15, I get $1.22, get them called away at 230. I can make $800 on IBM if I buy the shares and then I sit through earnings and earnings is positive. Okay, so this would be like 1 week after earnings. So in order to do that, if I bought the shares at, let's say 223, I get my $1.22 on a collar trade. So that's credit, lowers the cost basis. I mean, near term, that's probably like the fastest way to turn this into profit if IBM earnings are positive. So 223.15 would be my buy price, give or take. Take away the $1.22 credit, and then it's protected. So if it goes lower than 215, I can turn that into some profit. If it goes above 230, I get it called away, and the 221.93 gets called away for 807 in income. If it's one contract, I make $800, and I could do that trade tomorrow with the expiration out to the 7th. So I'd sit on the trade for 28 days, and I'd still be able to trade through earnings. I'm protected through earnings, so if the stock were to drop aggressively, I can then use my long put, lower my cost basis a little bit. The expected move through earnings is going to be about $16 to $17. So hopefully that's enough to, offer at least a discount. And then I can just either take profit on the put and then roll this down and then reestablish like a fresh collar position. As long as I'm rolling or adjusting for 0 to credits. Like I don't want to roll for debits, I want to roll for credits. Okay. All right. And where would I really like to own it? 202 is fine. Okay. 202 would be great. Ideally would be like 160 to 170. I just don't know if we're going to get there. I could see a lot of stocks just going sideways for this first quarter, right? A little bit of a pullback, but no like crazy technical damage. But, again, I still have to be protected to the downside just in case. All right. IBM's on the watch list. What else? I got a bunch of stocks. I haven't seen all of them. AMD. AMD, it does check a lot of boxes here. It's crazy expensive on price to earnings, but so is tech in general. Current price, fair market value. I mean, that's way undervalued, which is pretty appealing. AMD, I know technically this stock continues to drop a little bit. I had some trades on these were losses last quarter, just little credit spread losses. So we're trading at 121. Stock is down 48%. I do wonder if we have a technical move coming like this. Is it starting to get into like a falling wedge scenario? Does it get worse before it gets better? Or is this like a little bit of a channel, and price is going to start like basing here? And then we look to see like, do semiconductors respond, or was the last year just a big bubble for semiconductors? I don't know. We can read it both ways. Some semiconductors sound like they're the greatest thing ever, and then others are just bandwagon. So I don't know what AMD wants to do. I like it fundamentally. I look at this, it's like, okay, that's 54% undervalued. What's it compared to the peers? So 37.1, and it's 108 on price to earnings. So it's obviously very expensive compared to its peers, but this is compared to like Qualcomm, Micron, Texas Instruments. I did a trade on Micron this week for this exact reason. 28.5 price to earnings versus average at 37. AMD, it's like, I like it, but do I like it that much? The one stock that also has like really high premiums is SMCI. I just don't trust this one enough, man. Look at how like this is a tough one. This was actually outperforming Nvidia, and then it wasn't. And this thing has dropped like it's supposed to go bankrupt. I mean, it's down 85%. That's a hard one to justify getting into unless you're going to be just like an income trade is one thing, but I would not be holding or owning SMCI. So anyway, AMD, maybe. So I'll add it to the mix. Let's see here. Earnings coming up. IBM. JC, is that a symbol? No, you just said what? based on what I'm saying. Let's see here. EME. Papa John, I thought you pressed that button during the sleep. M-Core, EME, 475. What do they do? It's pretty good. Facility services. Is this in like is this utility space? What sector would they be in here? Let's check. EME. EME is M-Core? Yeah, M-Core. I mean, that looks pretty darn good. So fundamentally, it looks great. Price to earnings, not off the charts, but about market average right now. I like that. You know, for an expensive stock, still being 23% undervalued is pretty promising. And peer average is 61.9, and they are 23.6. I like that too. Okay, the only issue that I have is this is an expensive stock. Options wise, I don't know if this is fantastic or not. It could be mediocre. Yeah, like look at your option chain. It is now like if you're lucky, you're going to get a monthly expiration. I'm sure your spreads are going to be all over the place. The earnings is February 26th, and there's nothing really to trade earnings. You either trade the Feb 21 or the April 17 expiration. So you're either early or you're late. You're getting less than 10% on a covered call. If you did that's 98. That's probably less than. Oh boy. So yeah, you're getting like, what is that? Out of a $480 stock, let's say you're getting 20 bucks. You're getting about a 4.1% premium. I've seen better. I mean, the IV's at 29.6. So it's a really expensive stock for me to say I like it. You know, I mean, if you're dollar cost averaging into it, I think it's fine. You know, so where would I like to buy it? Well, bar count wise, on a daily time frame, I'm going all the way back here. This is a stock just like Nvidia, Netflix, Meta. I mean, this bar count goes way back here. 569 bars. Let me confirm that with my little where's my bar count? Bar count. So there's my bar count, and we're sitting at shows 296. That can't be right. Wait, what? Am I in the wrong chart? Daily. 200 EMA. Make sure that is a 200 close daily time frame. Yeah. This shows a massively long bar count. This one, not sure why. Oh, I got to change the stupid stock to there. Bar count is 615. Wow. Okay, that is a long, long, long bar count. So point is, what would I do with this? If this comes back down to $400, I would be willing to say I'll throw $500 to $1,000 at it and see if it wants to return. So performance-wise, how's this thing been performing the last couple of years in a pretty aggressive bull market? Last year was that right? In the last year, this thing was up 123%. Good Lord. I mean, that's pretty good. Is it overvalued? Apparently not. So what do they do real quick? And by the way, I've got to go here in a few minutes. I got a webinar at 4 o'clock. I'll post a link if anybody would like to join me for that. It's in my Telegram. Let's see. All right, so we got a link right here. So 4 p.m. webinar. If you'd like to sign up and join. If you'd like to join my Telegram, this is Chris Pulver Trading Telegram. That's a free Telegram channel. If you'd like to join my Discord, let's invite people. Let's make this a link here. And here's Chris Pulver Discord. There we go. All right. Papa John, I use your moving average on daily chart. to dollar cost average on crypto. I know, man. It's pretty tried and true. Like, I mean, if you look at your dynamic moving averages, you can use simple, you can use exponential, you can use weighted, you can use smooth, you can use triangular. It doesn't really matter. They're all going to be roughly the same. I mean, it's like EMA is my favorite because there's a little bit less lag, a little tighter to price. I've used EMAs for most of my career, but I just like the dynamic nature of them, and they're just really simple trade signals. So yeah, I think that's awesome. Anyway, so that was what I was going to say on EME would be if we come back down to the 200 moving average, and I'm going to set a chart alarm on this right now. So I'm going to go add an EMA alert on the daily time frame, and I'll just say look to buy, and then I'll put a DCA position. So dollar cost average position. The issue I'd have with this one if I bought it is that I'm not really going to do much with options around it. That's the downside. Plus, as far as the expirations go, limited trading on earnings. Or I'm sorry, limited trade on options and expirations. Like you're getting, monthlies and the strikes are probably wide. This might not be super liquid. You're only getting like 4 to 5% premiums on covered calls, like for the 30-day. So I think from an option standpoint, it's not awesome. Anyway, all right, that's that. Probably these moving averages that I have on my chart. It's a 21. You can see it right here. 21, 50, 100, 200, 144. So you can basically put the 144 in there, and it's when you see in a bull trend, I mean, you're getting a lot of tests off the 21 in an aggressive bull market. Anytime you get the consolidation, so aggressive bull market, you're getting like the 21 and the 50 to get hit several times. The market gets really explosive there. 21, 21 and 50, 21 and 50. This is the consolidation zone that I like to kind of accumulate, right? So this is a good opportunity to then look at, okay, we can accumulate stop loss below 200, and then all of a sudden we start to resume the trend, So what I'm looking for is, can this do the same thing? The 50 and the 21 consolidating. Does this go sideways enough to let all these go sideways? And like, if price is here and you see a bunch of like really tight connected moving averages, eventually when the stock breaks either lower or higher, that's like the next expansion phase of the move. So just an easy way to use some moving averages. And primarily for me, like it is stocks and crypto that I use it for. Futures, not so much. Forex, not so much. Those are mostly pure price action. So, all right. Hey, I got to jump into this webinar in a few minutes. We can resume this tomorrow for another final hour. Tomorrow is non-farm payroll. Forecast for tomorrow, 164,000. Unemployment rate at 4.2. Average earnings at 0.3. I'll look at the Bloomberg calendar as well. And then if we go to next week, I want to see what the forecasts look like for CPI and PPI year over year. Are we getting better or worse? Time will tell. It's going to put the Fed in a corner if we see a hotter PPI and CPI print next week. Fed's already in a corner. I think they are challenging the market's trust in their ability to navigate this soft landing because we are clearly seeing the bond market not cooperate. For the first time in history, basically we're seeing the bond market do the opposite of what the Fed has done and what the markets have responded to when the Fed does set action. So when the Fed cut rates, usually interest rates and yields go down. This year, the market's like, no, we're not doing it. So it's really, really strange how the market has done the complete opposite. And that is the market's way of pricing in higher inflation and pricing in that the Fed basically had a misstep in their monetary policy. What can we do about it? Wear seatbelt, wear hard hat, protect the downside, and buckle up for some volatility. Because like I don't know how this corrects. I don't know how this becomes like a new normal. I don't know if this is going to get worse before it gets better. So it's crazy when this is the first time it's happened. It's a little scary, And on top of that, we have this is what's happened since the Fed cut. You can see all yields going higher. This is the 20-year, the 10-year, the 30-year, and the 1-year yields all going higher. So that's why the bond market is in pretty much the toilet right now, and we're going to see if it gets worse. TLT down a pretty decent amount. Is it coming back to these 2023 lows before it was saved all by this like broad market high correlation? I don't know. Otherwise, if the bond market continues lower, that's going to be 3 out of 4 years in a nasty drawdown. And I don't know, something's going to break. I think the bond market breaks, and if the bond market gets worse, it's going to drag equities down with it. There's no way that equities can survive a bond market rout. There's no way. So, all right, I'll let you go for today. I'll see you tomorrow. If you want to join me in the 4 o'clock webinar, links posted. So you got my Discord, you've got my Telegram, and then the prosperitypub.com/results is going to be my daily profit play and my 4 p.m. webinar. Okay, thanks everybody. See you tomorrow. Bye-bye.